Beyond the checkbox, internal controls that actually work. Slide 1, internal control in a financial statement audit. Boom. What's up, future auditors? We're about to dive into the most critical aspect of auditing that separates the rookies from the professionals: internal control. You know what I always say: to learn accounting, you must do accounting. Well, today we're going to do internal control like nobody's business. And trust me, when you walk out of here, you won't just understand internal control, you'll be the smartest one in the room when this topic comes up. Before we jump in, I want you to think about this. What's the difference between a company that survives a recession and one that doesn't? Often, it's the strength of their internal controls. Just like Jay-Z said, "I'm not a businessman, I'm a businessman." And solid businesses need solid controls. Now let's get this party started and explore both sides of this coin: management's responsibility to design these controls and our responsibility as auditors to evaluate them. Internal control is absolutely the cornerstone of audit reliability. Without it, financial statements are built on sand. I promise you, this isn't your grandma's boring lecture on internal control. Slide 2, sales process example. Let me take you inside a hypothetical tech company, Apex Technologies. Picture this. Customer places an order, someone checks inventory, someone else checks credit, another person approves the sale, the warehouse ships the product, billing sends an invoice, and finally, collections gets that cash. Sounds simple, right? Wrong. This simple process is where millions of dollars get lost every year. Imagine if Apex was shipping products to customers who had defaulted 3 times already. Why? Because their credit check system wasn't integrated with shipping. Basic control failure. Think about your own online purchases. When you order from Amazon, why don't they ship you 10 of everything instead of just what you ordered? Controls, baby. Controls everywhere. Quick poll. Who here has ever received a product they didn't order or been charged incorrectly? Those are control failures in action, folks. This example illustrates how controls are embedded in real business flows. They're not abstract concepts, they're practical safeguards that prevent chaos. Every step in this process should have controls, and your job is to identify where they are and how well they're working. Slide 3, assertion level risks. Let's talk about what can go wrong in the sales process, what I call the danger zones. Think of these like potholes on the highway to accurate financial statements. Hit too many, and your audit is wrecked. Just imagine a healthcare company like Health Tech Solutions having to restate 3 years of financial statements because they were recording sales when contracts were signed, not when services were delivered. Their stock dropped 42% in one day. Let that sink in. Now picture yourself auditing a furniture company that was shipping empty boxes to customers, who were actually empty warehouses they controlled, just to record revenue before year end. Then they'd return the non-existent furniture in the next period. Classic revenue recognition fraud that costs investors millions. It's like that scene in The Wolf of Wall Street where they're selling worthless penny stocks to unsuspecting buyers. Except in our world, we're the ones who have to catch it. Let me break this down at every level. If you count your Halloween candy before your friend gives it to you, you're counting candy you don't have yet. Recording revenue before it's earned is like claiming your degree before finishing your classes. These examples highlight key assertion level risks, including recording sales that never happened, shipping without proper customer orders, and recognizing revenue in the wrong period. Recognizing revenue prematurely accelerates income recognition and violates the revenue recognition principle, potentially misleading investors about current performance. Slide 4, key preventive controls. Now for what I call the Fantastic Four of preventive controls. First up, segregation of duties. In banking, The person approving loans never handles cash disbursements. At technology companies, the engineers designing products cannot access sales figures. At major retailers, the person receiving inventory cannot record it in the system. Why? Because, as I always say, opportunity plus pressure minus controls equals fraud. System restrictions are your digital bodyguards. They don't call in sick, don't play favorites, and don't get distracted by Instagram during work hours. These restrictions prevent unauthorized shipments and keep people from exceeding their authority. Reconciliation of shipping and billing records is like fact-checking your Instagram influencer before buying what they're selling. Trust, but verify. This control ensures that everything shipped gets billed and everything billed was actually shipped. An aged receivables review process is boring, tedious, completely unsexy work. And it saved more companies from bankruptcy than any CEO ever has. This process helps identify potential fictitious sales that aren't being collected. The unsexy stuff is where the real money is made and saved, people. These 4 controls, segregation of duties, system restrictions, reconciliations, and reviews, are your frontline defense against financial reporting fraud. Slide 5. Management's responsibility for control. Let's get one thing crystal clear. Who's responsible for internal control? Management, not the auditor. As Kendrick Lamar might say, sit down, be humble. Auditors don't create controls, we evaluate them. You can lead a CEO to a control framework, but you can't make them implement it. This isn't just some accounting technicality. It's fundamental to understanding our role as auditors. I want you to write this down. Management designs, implements, and monitors controls. Auditors evaluate and test them. This distinction will save your career one day. Trust me on this. Imagine you're auditing a major retail chain whose CFO tries to blame their auditors for not catching inventory theft. You'd have to explain that their lack of physical inventory controls wasn't an audit failure, it was a management failure. That conversation wouldn't be pretty, but it's necessary. Management must design systems to protect assets and support accurate, useful information for decision-making. We as auditors depend on this reliability for effective audits. You all have the power to explain this concept clearly to clients. Don't shy away from these conversations. They're how you establish yourself as a trusted advisor rather than just a compliance checkbox. Slide 6. The auditor's risk assessment process. Our approach to internal control is like a doctor's approach to your health. We don't start by testing everything. We identify risk factors first, then focus our examination where problems are most likely to occur. You know what keeps auditors up at night? Not the complicated accounting standards, not the tight deadlines. It's the fear of missing that one key control that's failing right under our noses. So how do we sleep at night? By mastering the risk assessment process that I'm about to share with you. We evaluate design. Is this control capable of preventing or detecting misstatements? We evaluate implementation. Is this control actually being performed as designed? We evaluate consistency. Is this control performed every time, not just when convenient? Just imagine a blockchain financial company having to disclose a material weakness in their control over crypto asset verification. They had a beautifully designed control, but nobody was actually performing it. Design without implementation is just wishful thinking, folks. This risk assessment process directly shapes our overall audit strategy. Based on our understanding of controls, we plan our audit tests with surgical precision, focusing on the highest risk areas where misstatements are most likely to occur. Remember this: a perfect control on paper is worthless if it's not performed in practice. Write that down. Slide 7. Benefits of technology in control environments. Let's talk tech, baby. Technology has revolutionized internal controls, and if you're not leveraging it, you're living in the accounting stone age. You know how Iron Man's suit has all those automated systems protecting him. That's what good technology does for your controls. It automates protection. Netflix uses AI algorithms to detect unusual account access patterns, preventing fraud before it happens. Starbucks' inventory management system automatically reorders supplies when they hit predetermined levels. No human intervention required. Tesla's manufacturing has real-time quality control monitoring that stops the production line if defects are detected. Humans get tired, humans get distracted, humans take sick days and vacation. Automated controls, they work 24/7, 365, never complain about overtime, and don't need performance reviews. Technology enables faster processing, consistent enforcement of business rules, enhanced data visibility, and better security through user roles and access logs. Quick question: would you rather trust a human to consistently apply the same rule to 10,000 transactions or a well-programmed system? Exactly. Consistency is where technology shines. Now, I know what some of you are thinking. Are you saying computers will replace auditors? Not a chance. They'll replace bad auditors who don't understand how to leverage technology. Slide 8, technology-driven risks. But wait, the same technology that makes controls stronger can also create spectacular new ways for things to go catastrophically wrong. Imagine working at a financial services firm that upgraded their ERP system and someone made one tiny error in the configuration. For 3 weeks, every single Forex transaction was recorded with the decimal point in the wrong place. We're talking millions in misstatements that took months to clean up. Remember the recent Capital One data breach? 106 million customer records exposed because of a misconfigured web application firewall. One control failure, 106 million problems, danger zone. When technology fails, it fails at scale. The potential threats are serious. Data processing errors can affect thousands of transactions instantaneously. Unauthorized data access or changes can compromise entire databases. Inadequate system updates can leave vulnerabilities wide open, and over-reliance on faulty applications can blind organizations to growing problems. Data processing errors in automated systems are like viruses. They replicate perfectly, spread rapidly, and the symptoms aren't obvious until significant damage is done. This works on the computer level, the organizational level, and the industry level, if the error affects regulatory reporting. Think about your own banking app. What if it suddenly started rounding all transactions down instead of to the nearest cent? Would you notice immediately? Probably not, but the bank would be hemorrhaging money with every transaction. Technology amplifies both our capabilities and our mistakes. That's an original. You can quote me on that. Slide 9. Control system objectives. Every internal control system, whether it's at a Fortune 500 company or your local coffee shop, has 3 fundamental objectives. First, ensure accurate and reliable financial reporting. Second, promote efficient and effective operations. Third, support compliance with laws and regulations. As Notorious B.I.G. would say, if you don't know, now you know. These 3 objectives are the foundation of everything we do in internal control. Think of these objectives as the 3 legs of a stool. Remove anyone, and the whole thing collapses. Which of these 3 do you think is most important to auditors? That's right, reliable financial reporting. But never forget that the other 2 create value for the business beyond compliance. A well-designed control system helps companies achieve all 3 objectives simultaneously: accurate reports, efficient operations, and regulatory compliance. I call these the 3 R's of internal control: reliability, resources, and regulations. Master these, and you're speaking the language of executives, not just accountants. Slide 10. The 5 key components of internal control. Now we're getting to the meat of our topic, the 5 powerful components that make up an effective internal control system. Would you build a house without a foundation, drive a car without wheels, launch a rocket without fuel? No. So why would you run a business without these 5 essential components of internal control? Think of internal control as a hand, with 5 fingers working together to grasp complex business processes. 1. Control environment, the palm that supports everything else. 2. Risk assessment, the index finger that points to dangers. 3. Control activities, the middle finger that stands tall against threats. 4. Information and communication, the ring finger that connects everything together. 5. Monitoring, the pinky that might seem small but provides essential balance. The famous 5. These 5 components work together. One without the others is like having a basketball team with only a center. You need all 5 positions to win. This framework is comprehensive. It covers the culture, the processes, the activities, the information flow, and the ongoing evaluation that make controls effective. In the next few minutes, I'm going to break down each component in a way that will make you the internal control expert in any room. Let's dive deeper. Slide 11. Principles of control environment. Picture this. You walk into a client's office. Before seeing a single document, before testing a single control, you already have a feeling about their control environment. How? Because you can feel it in the culture. Remember WeWork's collapse? Classic control environment failure. When your CEO is using company money to buy a $60 million private jet while the company is losing billions, that's not just poor judgment, that's a toxic control environment. The control environment is like the soil in a garden. You can plant the prettiest flowers, controls, but if the soil is toxic, nothing healthy will grow. 5 elements create a strong tone at the top. First, an ethical culture where integrity isn't just a poster on the wall, but demonstrated in everyday actions. Second, board independence that provides real oversight, not rubber stamps. Third, clear structure and authority so everyone knows their responsibilities and boundaries. Fourth, competent staffing with the right skills and training to execute controls properly. Fifth, strong accountability, where people face consequences for control failures. At Southwest Airlines, their culture of safety creates a strong control environment from top to bottom. At Enron, well, we all know how that turned out. The difference wasn't in their written policies, it was in the real values demonstrated by leadership. Quick check. When's the last time you saw an executive at a company override a control just this once? That one override says more about their control environment than 1,000 pages of policies. As Jay-Z would say, men lie, women lie, numbers don't. But guess what? In a weak control environment, numbers lie too. You all have the power to assess control environments accurately. Trust your instincts when something feels off. If executives talk about ethics but reward results at any cost, that's a red flag. Slide 12, Principles of Risk Assessment. Risk assessment. This is where the rubber meets the road, people. If you don't know what could go wrong, how can you possibly design controls to prevent it? Imagine working at a cryptocurrency exchange that spent millions on controls over their trading systems, but completely overlooked the risk of internal theft from wallet private keys. What happens? 18.4 million walks out the door because an employee had unrestricted access to cold storage keys. Think of risk assessment like this. It's checking for monsters under the bed before you go to sleep. It's researching side effects before taking a new medication. It's a systematic process of identifying, analyzing, and responding to factors that threaten financial reporting objectives. Effective risk assessment focuses on how organizations accomplish 4 critical tasks. First, they clearly define goals at every level so they know what they're trying to protect. Second, they systematically identify risks and changes that could impact those goals. Third, they specifically assess fraud potential, recognizing that some risks are intentional, not accidental. Fourth, they develop appropriate responses to both internal and external risk factors. Just last quarter, Target reported a major inventory shrinkage problem affecting their margins. Why? They changed their store layouts, but didn't reassess theft risks with the new design. Basic risk assessment failure. I want you to repeat after me. Change creates risk. One more time. Change creates risk. What's the biggest change your hypothetical client experienced this year? That's where you start your risk assessment. New system, new leadership, new business model, new regulations. Change creates risk, people. Slide 13. Principles of control activities. Control activities come in 3 delicious flavors. Preventive controls, stop problems before they happen. Detective controls, find problems after they happen, but before they get worse. Corrective controls, fix problems after they're discovered. It's like that movie Minority Report. Preventive controls stop the crime before it happens. Detective controls are the regular police solving crimes after they occur. And corrective controls? That's the cleanup crew fixing the mess. The principles of control activities lay out how companies put control concepts into action. First, they choose appropriate controls based on the specific risks they face. Not every control fits every situation. Second, they implement these controls through clear policies and procedures that everyone understands and follows. Third, they integrate these controls into their IT environments so they work consistently and automatically when possible. Amazon uses preventive controls by requiring manager approval for price changes over certain thresholds. Netflix uses detective controls by analyzing viewing patterns to identify shared passwords. Costco uses corrective controls by automatically adjusting inventory records when discrepancies are found during cycle counts. I call these the before, during, and after controls, addressing the full timeline of risk. Here's the irony. The cheaper controls, preventive, are usually the most effective, while the more expensive controls, corrective, are usually the least effective. An ounce of prevention is worth a pound of correction, folks. Think about your own life. Where do you use preventive versus detective controls? Do you check your bank balance before making a big purchase? Preventive. Or just hope you don't overdraft? Detective. The same principle applies in business. Slide 14. Principles of information and communication. Information and communication are the nervous system of your control environment. Without them, you've got a company with a severed spine, parts moving but not coordinated. Boeing 737 MAX crisis, classic information and communication failure. Engineers knew about problems, but that information never reached the right decision makers. Lives were lost because information didn't flow properly. Imagine working at a healthcare company where the billing department and clinical staff used completely different systems that didn't talk to each other. Result? They performed thousands of procedures they never billed for. Millions in revenue just vanished because 2 departments couldn't communicate. Effective information and communication systems have 3 critical characteristics. First, they use relevant, timely, and reliable data that supports sound decision-making. Second, they clearly share control responsibilities internally so everyone knows their role in the control system. Third, they communicate critical issues to external parties when necessary, maintaining transparency with stakeholders. Think about group projects in school. What's the number 1 complaint? Someone didn't communicate what they were doing. Same in business, but with billion-dollar consequences. Information trapped in silos is like money burned in a fire, valuable assets rendered worthless. Write that down. Quick question. How many of you have ever discovered that another department had information that would have made your job easier if you'd known about it earlier? That's not just frustrating. In business, that's a control failure. Good communication must be clear, understandable, complete, all relevant information, and timely when needed. This applies to communicating with clients, with colleagues, and with regulators. Slide 15. Principles of monitoring activities. You've designed amazing controls, implemented them flawlessly, communicated them perfectly, and then walked away and never checked if they're still working. Disaster waiting to happen. It's like that old infomercial, set it and forget it. Works great for rotisserie chickens, terrible approach for internal controls. Monitoring is like a health checkup for your control system. Skip too many checkups, and suddenly you've got a serious condition that could have been prevented. The principles of monitoring activities focus on 3 essential practices. First, organizations must conduct regular or one-time evaluations of their control systems to ensure they're still effective. Second, they need to promptly report any weaknesses discovered during these evaluations to those who can fix them. Third, they must take corrective action efficiently. Finding problems means nothing if you don't fix them. Wirecard, $2 billion missing and nobody noticed for years. How? Complete monitoring failure. Their controls looked good on paper, but nobody was checking if they actually worked. Google constantly monitors API access for unusual patterns. Coca-Cola regularly tests product samples from production lines. American Express continuously monitors transaction patterns for fraud indicators. Monitoring asks 3 essential questions. Are our controls still present? Are our controls still functioning? Are our controls still relevant to current risks? Let me ask you this. What happens to a control that's never monitored? That's right. It atrophies, becomes a checkbox exercise, or gets bypassed entirely. An unmonitored control is no control at all. That's another original. Write it down. Slide 16, Audit Strategy and Risk Model. All right, math nerds, this one's for you. The audit risk model is the beautiful equation that guides our entire strategy. Audit risk equals inherent risk times control, risk times detection risk. This isn't just some formula to memorize for exams. This is the backbone of every audit decision you'll ever make. Let me break this down. Inherent risk is like the baseline danger of an activity. Skydiving has higher inherent risk than walking. Control risk is like the quality of your safety equipment. Good parachute equals lower risk. Detection risk is like your alertness level. Eyes wide open equals lower risk of missing dangers. Control risk, CR, is the specific element we're focusing on today. It's assessed based on control design and operation. If controls are well designed and operating effectively, control risk can be set lower. If controls are poorly designed or not working, control risk must be set higher. This model directly informs how much substantive work is needed. If control risk is high, we need more substantive testing to maintain an acceptable audit risk level. If control risk is low, we can reduce our substantive testing. Imagine you're auditing cash for a client with perfect bank reconciliations, low control risk, and simple banking, low inherent risk. You could examine fewer transactions, higher detection risk, while maintaining the same overall audit risk. Quick test. If control risk goes up, what happens to detection risk if we want to keep audit risk constant? That's right. Detection risk must go down, meaning more testing. The audit risk model isn't just how we plan audits, it's how we defend our approach when questioned. Let that sink in. Slide 17, Visualizing control's role in the audit. Picture yourself at the start of an audit staring at a flowchart similar to this one. This isn't just a pretty diagram. This is your roadmap to an efficient, effective audit. This flowchart is like GPS for auditors. It shows you where you are, where you're going, and the decision points along the way. Look closely at this critical junction right here. Do we rely on controls or not? This single decision impacts everything downstream in your audit approach. The flowchart maps the entire process from understanding control to adjusting audit procedures. It shows how we start by gaining an understanding of the client's business and industry, which helps us identify potential risks. We then understand internal controls to assess how well those risks are mitigated. Based on this understanding, we make a critical strategic decision. Will we adopt a substantive strategy or a reliant strategy? This decision directly influences the nature, timing, and extent of our audit procedures. Throughout this process, we're making professional judgments about where material misstatements are most likely to occur and how best to address those risks within our audit plan. It's like that Robert Frost poem, "Two roads diverged in a yellow wood." Except in auditing, one path leads to control testing and reduced substantive procedures, and the other leads to extensive substantive testing. Poets write about nature, auditors write about control flowcharts. We're so cool, aren't we? This visual representation isn't just for planning, it's a powerful way to explain your approach to managers, partners, and even clients. Master this flowchart, and you master the audit process. Slide 18, Substantive Strategy Overview. Let's talk substantive strategy. When do we use it? When controls are weak or not relevant. Perfect example. When auditing cryptocurrencies at smaller exchanges, most firms use a purely substantive approach. Why? Because the technology is changing so rapidly that controls can't keep up, so we go straight to the blockchain for verification. A substantive strategy is like checking every item in a grocery bag instead of trusting the cashier's scanning system. More time-consuming? Yes. Sometimes necessary? Absolutely. In these situations, control risk is assessed as high. We emphasize substantive procedures, detailed tests of transactions and account balances, because we can't rely on controls to reduce our testing. We might test larger samples, perform more extensive analytical procedures, or look at transactions in greater detail. In some cases, particularly for smaller entities with limited segregation of duties, we might bypass control testing entirely. This doesn't mean we don't understand controls, that's still required, but we don't test them for operating effectiveness. Imagine you're auditing a small family business where the owner's mother is the bookkeeper, the owner's wife is the treasurer, and the owner approves everything himself. Segregation of duties? Non-existent. You'd go fully substantive because testing controls would be pointless. Think about it. Would you test the effectiveness of a lock on a door if you can see the door is hanging off its hinges? Of course not. Same principle applies to obviously deficient controls. As Migos would say, walk it like I talk it. If a company talks about having controls but doesn't walk that talk, we go substantive all day. When in doubt, substantive it out. Not the most elegant phrase, but you'll remember it when you need it. Slide 19, Reliance Strategy Overview. Now let's flip to the other side, the reliance strategy. This is when controls are strong and relevant, and we can use them to our advantage. Think about auditing PayPal's payment processing, millions of transactions daily. Testing each one substantively? Impossible. But testing the automated controls that process all transactions? That's efficient auditing. When controls are deemed effective, we test those controls to confirm they're operating as designed. If our testing supports a conclusion that controls are indeed effective, we can set control risk lower than maximum. This allows us to reduce our substantive testing while maintaining an acceptable level of audit risk. The reliance strategy is like checking that the factory makes good cookies instead of tasting every cookie, verifying the professor's grading rubric instead of regrading every exam. Testing the effectiveness of systematic controls that apply to entire populations rather than examining large samples of those populations. This strategy is particularly efficient for high-volume routine transactions where testing every transaction would be impractical. For instance, in a company processing thousands of sales transactions daily, testing controls over sales processing is much more efficient than extensively testing individual transactions. Quick poll: who's worked on an engagement where you tested controls and reduced substantive testing? That's real-world application of the reliance strategy. This strategy requires professional judgment. You need to determine which controls to test, how many to test, and how much to reduce your substantive procedures. That's where you add value as an auditor. Test one control that applies to 1,000 transactions rather than 1,000 transactions controlled by nothing. Pure wisdom right there. Slide 20. Understanding controls is always required. Listen up. This is the part students often miss, and it's crucial. Understanding internal control is always required, even when you're not testing controls. You might not test controls, but you must understand them. You might go fully substantive, but you must know the control system. There are no exceptions to this requirement. None. Imagine a junior auditor skipping documenting their understanding of controls because they were using a substantive approach. Partner review would come back like a hurricane. Why? Because without understanding controls, you don't know where misstatements might occur. Even when not planning to rely on controls, we need this understanding to identify types of potential misstatements, consider factors that affect risks of material misstatement, and design appropriate audit procedures. This understanding helps us know where things might go wrong so we can focus our testing accordingly. For instance, understanding weak points in the revenue cycle helps us determine where revenue might be overstated or recorded in the wrong period. Remember that major retailer that had inventory shortages last year? Their auditors went substantive but didn't understand the inventory control system changes. Result? They tested the wrong locations and completely missed the fraud. As Sun Tzu said in The Art of War, know yourself, know your enemy, and you need not fear the result of 100 battles. In auditing terms, know the business, know the controls, and you need not fear the result of any audit. This isn't optional, people. It's required by auditing standards and essential for audit quality. So remember, while testing controls for operating effectiveness is optional, understanding the control system is mandatory for every audit. Slide 21. How auditors gain understanding. Time for the how. How do we actually gain this understanding of internal control? I call these the 4 I's of control understanding. Interviews with key personnel, inspection of documents, inquiry into processes, imitation through reperformance. Some auditors think they can gain understanding by just reading manuals. Wrong. Control understanding is a contact sport. You've got to get in there and mix it up. Auditors use various techniques to gain an understanding of internal control. Interviews and walkthroughs are particularly valuable. We speak with personnel involved in the process and follow transactions from initiation to recording in the financial statements. This helps us understand both the design of controls and whether they've been implemented. Observation allows us to see controls in action. For example, we might observe how warehouse personnel handle goods received or how supervisors review subordinates' work. Inspection of documents and records provides evidence about control design and implementation. We might review policy manuals, job descriptions, or evidence of review signatures on documents. And for complex IT systems, we may need IT specialists to help evaluate automated controls. Imagine spending 3 days just observing the count room procedures at a casino. Why? because reading their policy manual tells you what should happen, but observation shows you what actually happens. Here's a challenge. Next time you're auditing a process, try explaining it back to the client without looking at your notes. If you can't, you don't understand it well enough yet. Control understanding is like learning to drive. You can read the manual all day, but until you get behind the wheel, you don't really understand it. This is where great auditors separate themselves from good ones, by developing a deep understanding of controls rather than a superficial checklist approach. Slide 22. Documentation tools for control understanding. Documentation tools are like different cameras capturing the same scene from different angles. Each gives you a unique perspective on controls. Narratives tell the story of a process. The sales clerk enters the order, then the credit department approves it. Flowcharts show the journey of a transaction. Each step, decision point, and handoff visually mapped. Questionnaires ask the right questions. Who approves credit? How are exceptions handled? Common documentation includes policy and procedure manuals that provide a formal view of how controls should operate. Organizational charts that show reporting lines and authority. Flowcharts that visually represent the flow of transactions through the system. Internal control questionnaires that systematically address key control points. And narrative descriptions that document walkthroughs and control procedures. It's like dating apps. Some people prefer Tinder's swiping, others like eHarmony's questionnaires. But they're all trying to accomplish the same thing. Find the documentation method that works for you and the process you're auditing. Quick question: who here is a visual learner? Flowcharts might be your go-to. Who processes information better in narrative form? Narratives might work better for you. Different tools may be appropriate in different circumstances. Flowcharts work well for visualizing process flows, while narratives might better capture complex judgments. Most audit files include a combination of these documentation methods. The best auditors don't just stick to one method, they combine approaches to get a complete picture. A flowchart supported by narrative explanations of complex areas gives you both the forest and the trees. Slide 23. Flowchart example of process control. Look at this flowchart. This isn't just boxes and arrows. This is a story of how a sales transaction moves through a company. Let's trace a transaction together. Order comes in here, goes to credit approval, there, then to shipping here, then to billing there, and finally to accounts receivable here. These diamonds are like control checkpoints on a highway, stopping risky transactions from proceeding without proper approval. This flowchart shows the flow of a transaction through different departments, from sales to credit, to shipping, to billing, to accounts receivable. It demonstrates where controls can be inserted or break down. Notice the control points marked throughout the process. For instance, there's a credit check before order approval, a comparison of the shipping document to the approved order before shipment, and a three-way match of order, shipping document, and invoice before recording the sale. Imagine reviewing a flowchart like this and noticing something odd. There was no connection between shipping and billing. Turned out the company was shipping products, but sometimes forgetting to bill customers. A simple flowchart revealed $1 million problem. As Cardi B would say, "I like flowcharts and I like tracing, yeah?" Okay, maybe she didn't say exactly that, but you get my point. This visual representation helps auditors identify where controls might fail and where misstatements might occur. For example, if the three-way match isn't performed consistently, sales might be recorded for goods that weren't actually shipped. Flowcharts like this one help auditors understand both the flow of transactions and the controls designed to ensure their proper recording. Don't just glance at flowcharts, study them. They reveal control weaknesses that might not be obvious in narrative form. Slide 24. Use of control questionnaires. Control questionnaires, the unsung heroes of audit documentation. These babies ensure consistency across engagements. Think of questionnaires as your audit GPS. They make sure you don't miss any important turns on your journey through internal control. Control questionnaires provide a systematic approach to understanding internal control. These pre-formatted checklists include questions about key control points, typically organized by transaction cycle or control component. Good questionnaires ask things like, are shipping documents matched to approved orders before goods leave the warehouse? And does anyone verify that all shipments are billed? These questionnaires help ensure consistency across audit engagements and serve as reminders of important control considerations. They also provide documentation of the auditor's control understanding for review and future reference. Raise your hand if you've ever felt questionnaires were boring busy work. I see those hands. Now let me tell you, these boring questionnaires have saved more auditors from missing key controls than any other tool. Imagine thinking you could skip the standard questionnaire for a client you knew well. Big mistake. The questionnaire had been updated for new accounting standards, and you completely missed evaluating controls over the new requirements. Never again. While questionnaires are useful tools, they should be supplemented with other procedures like walkthroughs to ensure a comprehensive understanding of the control system. Questionnaires, boring to complete, essential to rely on. Another original for your notes. Slide 25, Control System Limitations. Now for some real talk, even the best control systems have limitations. Ignoring these limitations is like thinking your car's airbags make you invincible. Dangerous thinking. Human error can't be eliminated. Even NASA scientists make mistakes. Management override can defeat controls. Just ask Enron's shareholders. Collusion can circumvent segregation, like the Wells Fargo account fraud scandal. Small company limitations create inherent weaknesses. Mom and pop shops can't segregate like Fortune 500 companies. All systems are subject to these constraints. Despite our best efforts, all internal control systems have inherent limitations that auditors must recognize. Understanding these limitations helps us maintain professional skepticism and design appropriate audit procedures. Human error represents a significant limitation. Even well-trained, conscientious employees occasionally make mistakes in applying controls or processing transactions. Management override poses perhaps the most serious limitation. Those in positions of authority can potentially circumvent even well-designed controls, as we've seen in numerous financial scandals. Collusion between employees can defeat segregation of duties controls. If two or more individuals work together to hide improper actions, even strong controls might be rendered ineffective. Small firms present particular challenges, as limited personnel may make proper segregation of duties impractical. In these environments, owner-manager oversight becomes especially important as a compensating control. Just last quarter, Luckin Coffee admitted to fabricating $310 million in sales. How? Executive override of controls. No control system can completely prevent determined fraudsters at the top. Think about it. Have you ever made a mistake despite having a checklist or procedure to follow? We all have. That's why we need multiple controls to catch what slips through. Control limitations are like, even the best umbrella still lets some rain hit your shoes. Even the best locks can be picked by determined thieves. Control risk can be reduced to a low level, but never to zero. This is why we always perform some substantive procedures, no matter how good the controls are. Slide 26, Common Control Weaknesses. Let's talk about control weaknesses that show up again and again. I call these the greatest hits of control failures, and they're chart toppers nobody wants. These weaknesses are so common, they're like that friend who always shows up uninvited to the party. Nobody invited, inadequate segregation of duties, but there it is again, helping itself to the food. Experience has identified several common internal control weaknesses that auditors should watch for during their evaluations. These summarize typical internal control failures auditors encounter and can serve as a checklist during walkthroughs or planning. They include inadequate segregation of duties, such as allowing the same person to authorize transactions and maintain related accounting records, insufficient authorization procedures for significant transactions, inadequate documentation or record keeping, making it difficult to verify that controls operated as designed, lack of physical safeguards over assets or records, absence of independent checks or reconciliations, and inadequate monitoring of control performance over time. At small retailers, one person handling cash, recording sales, and reconciling the register. At tech startups, developers with access to production databases and customer data. At family businesses, related parties approving each other's expenses without oversight. Imagine auditing a nonprofit where the bookkeeper could create vendors, approve invoices, and sign checks. When pointed out, they said, "But she's been with us for 20 years. 2 months later, $50,000 missing, and guess who was responsible? These weaknesses are like cracks in a dam. They might seem small at first, but under pressure, they can lead to catastrophic failures. Familiarity breeds contempt in relationships, but in controls, familiarity breeds complacency. The longer a weak control exists, the more people work around it instead of fixing it. Identifying these common weaknesses is your opportunity to add value beyond the audit. Help clients strengthen these areas, and you become a trusted advisor, not just an auditor. Slide 27, Evaluating and Testing Control Risk. When we decide to rely on controls, we enter the testing phase. This isn't just checking boxes, this is detective work. We test through inquiry, asking the right questions to the right people. Observation, seeing controls in action with our own eyes. Inspection, examining evidence that controls operated. Reperformance, doing the control ourselves to verify it works. When we decide to rely on controls, we must test them to ensure they're operating effectively. This process begins by identifying key controls, those most critical to preventing or detecting material misstatements. How do auditors test Amazon's automated order processing controls? They create test transactions and trace them through the entire system. How do auditors test Apple's inventory controls? They observe physical counts and reperform reconciliations. Here's a scenario. A company requires 2 signatures on checks over $10,000. How would you test this control? That's right. Inspect a sample of large checks to verify both signatures are present. Control testing is like inspecting a bridge before driving across it. You don't need to check every bolt and beam, just enough of the critical ones to be confident it won't collapse. As Method Man said, cash rules everything around me. That's why controls over cash are usually the first ones we test. Follow the money, people. Based on our testing results, we draw conclusions about the level of control risk. If controls operate effectively, we can set control risk below maximum, allowing us to reduce substantive testing. If controls don't operate as designed, we maintain control risk at maximum and increase our substantive procedures accordingly. This testing provides a foundation for our overall audit strategy and directly influences the nature, timing, and extent of our substantive procedures. The extent of testing should be proportional to the reliance placed on the control. More reliance equals more testing. Slide 30. Communication of deficiencies. We've reached our final topic, communicating control deficiencies. This isn't just a technical requirement. This is your chance to add value beyond the audit opinion. Parallel structure with clear distinction. Control deficiency. A design or operation flaw that might lead to misstatements. Significant deficiency. a flaw that deserves attention from governance. Material weakness, a flaw that creates reasonable possibility of material misstatement. Auditors must communicate these serious findings to leadership in writing. Last year, 138 public companies reported material weaknesses in their controls. What happened to their stock prices? Average drop of 7.3% on announcement day. This stuff matters. Think about deficiency communications you've written or read. Were they clear about the potential impact? Did they offer practical recommendations? That's where you differentiate yourself as a professional. Imagine identifying a significant deficiency in a client's purchase approval process. Instead of just reporting it, you worked with them to redesign the process. Result: they fixed the control and improved efficiency. Win-win. Find the problem, suggest the solution, be the hero. That's how you turn control deficiencies into client victories. Auditors must communicate significant deficiencies and material weaknesses to management and those charged with governance in writing. This communication typically includes a description of the deficiency, its potential effects, and sometimes recommendations for improvement. This communication is an important part of the auditor's professional responsibility and provides value to clients beyond the audit opinion itself. We've covered the entire landscape of internal control in financial statement audits. From control environment to deficiency communication, you now have the knowledge to be the smartest person in the room on this topic. Think about what resonated most with you today. Was it the audit risk model, the 5 components, the testing approaches? Whatever it was, that's your starting point for deepening your expertise. You're not just learning this for exams, people. This is real-world knowledge that will make you better auditors, better consultants, and better business professionals. Internal control knowledge is like compound interest. It grows over time and pays dividends throughout your career. As we conclude today's lecture on internal control in financial statement audits, let me emphasize several key takeaways. First, understanding internal control is fundamental to the risk-based audit approach. This understanding informs our assessment of where material misstatements might occur and how we should focus our testing. Second, while management is responsible for designing and implementing controls, auditors are responsible for evaluating those controls as part of the audit process. Third, our assessment of control risk directly impacts our audit strategy, particularly the nature, timing, and extent of substantive procedures. Finally, remember that all control systems have limitations. Professional skepticism remains essential even when controls appear well-designed and effectively implemented. Remember what I always say: to learn accounting, you must do accounting.